بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على نبينا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله وبركاته. Okay, good. Welcome to chapter 23. Today's topic is option. Before we start, option is one of the types for derivatives. So there is one unit in the university called derivatives security. Basically, under a derivative, we have four components or four types. The first one called forward contract, then you have a future contract, then you have a swap, and the last one is options. Today, inshallah, we will cover options. Now think of options as a product, as a financial product. So in real life, we can buy shares, we can buy bonds. We also have another category called derivatives, such as options. So option, you can buy it. It's like one of the contract, okay? And we will talk more about this, inshallah, in this lecture. Okay, options give you the right, but not obligations to buy or sell something. So when we say options, think on it as a contract. So it is a contract between two parties. Always the contract will be between two persons or two parties. This contracts give the visitors, when he buy the contract, these options give you the right to buy something or the right to sell something, but not an obligations. Now inshallah we will explain this later in the next few slides. Okay, when we say options, we have two main types. The first one called call options, and the second one put options. For the call options, these options or this contract give you the right to buy an asset at a specific exercise price on or before the exercise date. So what is the story here? The story here, as an investor, you can buy something called call options from the market. So from the stock exchange, you can buy the call option. If you buy this call options, this will give you the right to buy. So always link call to buy. Okay, this will give you the right to buy an asset. Any assets, these assets could be shares, could be bond, could be currency, could be interest rate, could be any commodity like oil, gold, whatever. So these options give you the right to buy the assets. So it's up to you. If you are interested in buying oil, you will go and buy call options oil. If you are interested in buying gold, you will buy call options gold, and so on. So this will give you again the right to buy the assets at a specific price. We call it exercise price. So you will buy it at a specific price, which will be written in the contract, and the delivery will be in the future, okay, at the exercise date. So you buy today, but the delivery of the assets will be in the future. So this is call options. Okay, now put options give you the right to sell an asset at a specific exercise price on or before the exercise date. Okay, again, this is a contract that gives you the right, but here to sell, okay, not to buy. This will give you the right to sell an asset, which is, as I said, any assets at that specific price. So it's up to you as an investor. If you want to buy something, you should buy a call option. If you want to sell something, you will go for put options. Now let's give an example here, okay? Imagine you want to buy gold, 1 kilo gold, let's say after 1 year. Not now, you want this 1 kilo after 1 year. Okay, the only risk you buy when you buy this gold is that the price will go up in the future, right? So you want to buy gold after 1 year, you will be worried that the price of the gold will go up after 1 year, okay? So what you can do, you can buy today through the options. You can buy today and the delivery will be in the future. And when you buy today, you buy it at today price. Okay? So if you are interested in buying gold, you will buy a call options gold. Now, if you are a businessman and you have a gold shop and you have a large amount of gold, okay, you will be worried that the price of the gold will be down in the future because I am selling, right? If it goes down, then I will lose. So what you can do, you can buy a put options to sell a gold at the price today, and the delivery will be at the future. So you will be happy because you sell it at the current price, not at the future price. Okay, assuming you are exercising, the future price will go down. So this is why we need to use call and put. Okay, so here you look the price, you look at the current price. Now for any contract, whether it's call or put, there is two parties. There is a buyer and seller. When you buy a call options, you are a buyer, right? Because you bought the options. You are a buyer, and this will give you the right, not obligations, the right to buy an asset. On other hand, there will be a seller. Okay, so this is the second party in the contract. You buy something, or this will give you the right to buy something, and the seller, which is in the other party, will have obligations to sell the assets. Okay, so when you buy a call options gold, it means you have the right at any time to buy the gold, and the seller of the gold, he should sell you. Okay, so this is a guy, he don't have any option to the seller. The option on only for the buyer. For put options, again, as a buyer of put options, this will give you the right to sell the assets. On the other hand, there will be a seller who have obligations to buy the assets. So which means if you decide to sell the gold here in the put options, the other party, he had the obligations to buy the gold from you. Obligations means you have to, you don't have choice. Obligations, he cannot say no. Okay, so what I want to say here, call or put options, we give the flexibility or the right only to the buyer of the call or to the buyer of the put. Okay, now does the seller for a call options hope the price of the underlying security or underlying asset? When we say security, could be share, could be bond. So here we are talking about share and bond. But as I said, the assets could be anything. Could be gold, could be oil. So let's read the questions again. Does the seller of a call option hope the price of the underlying moves up or down? He always hope the price will go down. This is whom? This is a seller of call. And this seller will need to sell the assets. Assume it is gold, okay? You want to sell the gold. He will hope the price in the future will go down, so that he will sell it at the contract price, not the market price. So the market price will be down. He will not care about that because he will sell it based on the price in the contract. Now, does the buyer of put options hope the price of underlying security move up or down? So put options, he want to sell. If I want to sell something, I hope the price will go down in the future. Why? Because I will sell it in the contract price, not in the future price, right? Buyer of put, so put here means that put means sell. This will give you the right to sell. As I said, imagine you are a businessman, actually businesswoman, who want to sell 1 kilo of gold in the future. Okay, when you buy the contract, let's say the price is $1,000. Just to make it easy, assume the price is only for 1 kilo gold, it's $1,000. Okay, I imagination this number. This is in the contract. This is an option in the future. If the price of the gold goes down to $500, you will be happy. Why? Because you are selling at the contract price, not the marketing price. So you will be selling at $1,000 and the price in the market will be 500. So you will be happy if the price goes down because you will make a profit. You will sell it at the current price, not at the future price. Now, let's talk about the options value. The value of an option to expiration date is a function of two things, of the stock price and the exercise price, which means the value of the options depend on two factors. The first one, stock price, and the other one, exercise price. Okay, here here we assume we are talking about option for stock to make it easy, not gold. Let's say this is a stock, so the difference between the stock price and exercise price will give you that value. And we need to distinguish always whether we are talking about call or put. So always remember in any questions to read it carefully and to check whether you have call or put. If you have call options, then we have two scenarios here in the first box in the slide. It means the value depends on the two scenarios here. If the stock price at the expiration is greater than the exercise price, then the value of the call option will equal to the stock price minus exercise price. So this is like a formula that I highlighted in green color. This formula is correct only if the stock price is greater than the exercise price. Now, what is the exercise price? This is the agreed price in the contract. So this price is fixed when you buy the call. There will be written in the contract what is the price. So the value of call option will always equal to the stock price in the market at the expiration date minus the contract price. The second scenario, if the stock price is less than exercise price. In this case, the value of the option will be 0. Why? Because the investor will not use the option, will not exercise it, right? That's why we call it options. Option, it means you have the choice to exercise or not exercise. Okay, normally as an investor I always exercise and use the option as long as this will give me a profit. Okay, if I gain a profit. But in this case, if the stock price is less than agreed price, it means we will have a loss and it's better not to exercise. That's why the value is 0. This is for call. Now for put option, it is the opposite, because you are selling here in the second box, because we are selling if the stock price is greater than the exercise price. As an visitor, you will not exercise the option. If the stock price is less than the exercise price, you will exercise the option, because it will make a loss here if the stock price is less than exercise price. So the value of the put option will equal to the exercise price minus stock price, which I highlighted in a blue color. So you need to remember whether you are call or put. Then each of them have two scenarios. Now to understand this more, we have an example in the next slide, inshallah. Okay, assume we have an option and the exercise price is $720. When we say exercise, this is the agreed price in the contract. So this will never change. It's written in the contract. Assume it's written 720, the price of the assets, assuming you want to buy a stock. Okay, so based on the contract, the price in the contract is 720. Now here we will make this example based on two scenarios, whether you have call options or put options. Okay, if you have call options, call means what? Call means you can buy, right? Call options for exercise price of $720. it means you can buy the stock at 720. Now, the first line in the table, we have the stock price. Okay? In the second line that I highlighted in orange color, if the stock price in the market is 600, which means they are selling this stock at $600. But in the contract, we agreed price what? We agreed in 720. So in this case, you will not exercise the option. Why? Because it's loss. Why you buy it 720 and in the market it's 600? It's better not to buy it like using the call, right? Same for the 660. Still 720 is higher than the 660. No need to buy. Also same for 720 here. They are equal. No need to buy. But if the stock price is 780 in the market and you agree to buy this one at 720 in the contract, then this is a good contract, right? You are buying at 720 and in the market is very expensive, 780. You will make $60 profit because you will buy it at 720. Same if the price is 840, you will make 120, which is the difference between 840 and 720. So this is for call. Now, in the third line that I highlighted in pink color, for put, remember, for put it means we are selling. If the price in the contract is 720 and the price in the market 600, it's better to sell at the agreed price. So in this case, you will use the contract because this will give you a profit, $120, right? So you are selling at 720 in the market. It is 600, but you can sell it at 720 and make a profit 120. Same for 660. 720 is more than the 660. The profit is 60, and in 720, 780 and 840 you will have 000 because there are no benefit. So this is the opposite of the second line. Now, the first question in the slide, what are the payoff limit for call options buyers and sellers? For buyers, 720 or above. Why? Because below 720 there is no benefit. And for sellers, 720 or equal, because below 720 there is no benefit. The second question is, what are the payoff limit for put options buyer and sellers? Okay, for buyers, 720 or equal, because below 720 there is no benefit. And for sellers, 720 or above, because below 720 there is no benefit, right? Okay, we will talk about the call options like as a graph. Now, we are talking about the value. Again, you need to remember whether you are a buyer or seller and whether you have a call options or put. We will start with the call. Imagine we have a call options, okay, and the exercise price 720 and you are the buyer. In this case, this is the red line is the graph for the value. So what do we have here? On the x-axis we have the share price. On the y-axis, this is the value of the options. Now remember that agreed the price, we agreed 720. So assumed 720 is the green dot in the red line here. Okay, if the share price is less than 720, which is the area below 720, below I mean the left of the 720, I will not exercise the option, so it will be 0. That's why the red line is in 0. Actually we are drawing the previous one, which is here. Okay, you remember the orange color? Actually this is the call option. Okay, it will be 000 till 720. After that I will go up. Okay, and this is the graph. You have this red line 0 till 720 and the green 720, the green dot, then you will go up. Okay, now let's talk about profit, not value. For the profit, here in the slide we have the formula that I highlighted in green color. Profit for the buyer, it's equal to the current price minus exercise price minus the cost of call. Imagine the cost of call option is $20. Think on it like a coupon. You can buy this contract with $20. It's like coupon, okay? Certificate. You can buy it with $20 and the price in the contract to buy the stock is $720. If you want to calculate the profit, follow the example here in the slide, follow the formula, and this will give you 100. Okay, the graph exactly the same as the previous one. You just here you need to deduct the cost, which is $20. So the red line will be below the zero because you will lose here minus 20. Okay, so this is a copy paste of the previous slide. It will be just the dashed line below it. Okay, so now here we are talking about the buyer of the options. For the seller, it is the opposite. Okay, so here you are talking about the value. The value will be the opposite for the seller. Okay, so opposite of this graph. So this graph was 0, then go up. Okay, here the graph will be 0, then go down. Okay, for a profit again the same, but we're just moving $20 above. Okay, now we have another example. How much must the stock be worth the expiration date in order for a call holder to break even if the exercise price is 50 and the call premium is $40? Okay, so first of all we have here a call options. Always you need to check whether you have a put or call. Okay, this is a call. Now to calculate the profit from the previous slide, the formula that I highlighted in the green color, call profit always equal to the stock value minus exercise minus cost of or premium. Like the premium is sometimes we say it is cost of call. From the questions, the premium or cost of call is 4. The exercise price, which is agreement price, is $50. Stock value, we need it. So the questions, how much must the stock be worth in order to have break even? When we say break even, it means you will have zero profit. So in management or in accounting, when we say break even, it means you will have zero profit. So here in the formula that I highlighted in green color, you put 0. Okay, then after that lay on the equation. This will give you a stock value of $54. Now we are done with the call options, so we know how to calculate the profit and how to draw the profit and value for the buyer and for the seller as well. Just remember the graph, whether it's up or down. Okay, now let's talk about put options. Put options, it will be again opposite of the first one, the call options, which means at the beginning you will have profit, then you will have 0. Okay, you will not exercise here in the right of 720. So basically here I am now drawing this spot value in the third line that I highlighted in pink color. At the beginning you will have 120 and 60, then 0, 0, 0, right? So which is here the blue line, then 0, 0, 0. So anything above, I mean the right of 720 will be 0, and here we are calculating the value. Okay, so we will do it again, but for the profit exactly the same, just you go down by the amount of the cost or the premium, which is $30, and here we are talking about the buyer of the option. For the seller of the options, it will be the opposite, down, negative, I mean less than 0, and here negative, then 0. Okay, but you will go with the dash line. Okay, so you will go for the dash line for the profit. Okay, we have example. What is your return? on exercising a put option which purchased for a $10 exercise, a price $85 and the stock price is $81. So what we have here, we have put, we have the cost of the this put is $10. The agreed price is 85. The stock price in the market is 81. Based on the formula that I highlighted in blue color, 85 exercise price minus stock price 81. This will equal 4. The result 4, we call it proceeds or value, not a profit. If you want to calculate the profit, then again you need to deduct also the cost, which is $10. Using the formula that I highlighted in the pink color, the profit is minus 6. Also remember here the formula for put is different from the call. So this is a formula for put that I highlighted in the blue color. It always exercise a price minus a stock price. However, for the call is a stock price minus exercise price. Okay, so this is how it is for the call. This is the formula for the put that I highlighted in the blue color. Also, this is a formula that I highlighted in the pink color, but we have actually here we did it in two parts. Okay, then we if you want to the return as a percentage, it will be 6% divided by the cost, which is 10, and this will equal minus 60%. Okay, now actually from slide 17, 18, 19, 20 is not that important, but anyway I will explain it for you just for your knowledge. Okay, but don't focus on it. Okay, so here we have options hedging strategy, something called the protective put. So a protective put is a hedging strategy involving two positions. One is a long stock and a long put. So protective put again has got two things, long stocks and long put. Combining these to get the line called protective put. So how it's work? So let's say in this graph we show how it's work. So the graph essentially shows the relationship between positions value and the share price. So let's start with the long stock first. Long stock means buying a share. So let's say you buy a share at $40 and after you buy it, share price goes up. So as the share price goes up, your position's value goes up as well. Let's say you buy the share at 40 and after that share price goes down. As the share price goes down, position's value goes down as well. So long as a stock graph, which is the dashed line, the small dot graph, shows a positive relationship between share price and positions. The second part of the protective put is the long put, because in the definition, if you see the definition of the protective put, okay, we see protective put is actually a long stocks and long put. Now what happened here? You see when you have a good long stock, okay, you buy the share at 40, but anytime share price goes down from $40, let's say 25, let's say 20, let's say 15, we are making loss. So protective put is a strategy whereby will be able to protect the loss. How do you protect the loss? We protect the loss by buying a put options. When we buy a share, so we buy a share at the same time we buy it put. Okay, so what happens? We buy a put. Put means like to sell, right? So let's say I have got a long stock, let's say Tesla shares. Okay, I bought it at $40 and at the same time I have got a long put on Tesla, meaning that I can sell Tesla shares. So if I buy the shares at 40 and I have a long put at, let's say 45, then if the market shares of the market price of the Tesla shares goes down, let's say became 25, I can use my long put, because long put means I can sell that share at the contract price, which is let's say $45. So I bought the shares at 40, and if the shares price goes down to 25 or 30 or 15, I will be losing. But I am protecting the loss by buying a put options and the contract price of the put options for this exercise price is 45. So if the market price of the stock Tesla shares gain 15 after I buy it, I can still sell the same shares at the put with the contract, and I can sell it at 45 by making sure that I am not losing. So that's why the long put graph is like this. What is this? It is showing that as the share price goes down, I am actually gaining, because let's say the contract price is 45. So if the market price became 35, I will be gaining $10, okay? So if the market price became 25, I will be gaining $15. If the market price became 20, I will be gaining $20. So against the contract price. So it shows that as the share price goes down, the put value goes up. But as the share price goes down, long stock value goes down. So put value goes up, long stock value goes down. Okay, and that's why I have got the average cutoff points, that solid line, and then after some point you see the put value continue protective put value constantly goes up, okay, as the long stock goes up. And why is that? Because after that point, let's say the market price 45, so long put I do exercise it, right, because they strike price 45. But if market price is 55, I do not exercise long put. I will not. I do not lose anything. I do not exercise the option because I can sell the share in the market at 55. So what happens? My put is no longer valuable. I'm only losing the amount of the coupon. So that's why long put is solid straight line after that, after 45. However, the protective put is going up because share price is going up as well. So overall, this strategy shows that if I buy a share, I have a potential of loss. Okay, I can avoid the loss by buying put options. Here nothing to explain because I already explained it in the previous slide. Okay, call options value upper and lower limit. So stock price upper limit, lower limit is the difference between a stock price and exercise price, or zero. So whichever is higher. So when is call options value? How valuable call option is? What is the upper limit, lower limit? Call means right to buy, right? So stock price, that's the highest limit, or the difference between stock price and exercise price. So let's say you have a call options of Tesla shares at $45. If the market price is 35, what is the value you have? Market price is the 35. You have an option contract of 45. You are not going to buy from the option contract. You will buying from the market, and that is basically loss. So what is the value? The value limit is the contract is 45, but market price is 65. In this case, you will be having the contract. So you have a gain of $20. So your minimum will be 0, call option minimum value will be 0, and call option maximum value will be the difference between a stock price and exercise price. Okay. This is a slide that shows the value of call options, upper bound and lower bound. So what is the upper bound? Upper bound is that is going up with the share price. So as we have said, there is no limit of it. If I have call options contract of $45 for Tesla shares, and if the shares price became 55, I have gained 65. I have gained 75. I have gained 85. I have gained 95. I have gained 100. I have gained whatever. How much it can be. It is as much as the share price goes on, right? So the upper limit can be going up straight up upward. So that's the upper limit. What is the lower limit? The lower limit is basically if you buy a call options at 45 Tesla shares. If the market price is below 45, you are not going to exercise. That option will not be valuable to you because you can buy the shares. You remember the share call means is the right to buy, so you can buy the shares at the market at below 45. So that's why up to the exercise point, the call option is not valuable. That's why the line is flat 0 point, because you are going to buy the share from the market, okay, not from the call. If the share price is below the contract price, if the market price is 25, why you are going to buy the share from the contract at 45? You are not going to do that. So call option is not valuable to you, but after the exercise price, call option is going to be valuable. So if the contract price is 45, after the share price is going to be valuable. Call options will be valuable because if the market price is 75, you can still buy the share at 45 and sell it in the market at 75. You will have $35 gain. So these are two upper limit and lower limit. The green line in the between, what it shows, the green line in between shows the option price always exceeds the maximum value, okay, always exceed the minimum value options price, which is basically the minimum value is 0, which we have shown in the previous slide. 0 means you do not exercise. So in generally, if you have exercised it, the value means that you are making gains. So that's why option price is always higher than the minimum value. That's what the green line is showing in this graph. Okay, now this slide is important. Okay, in this slide we will talk about the call options. If the following variable increases, then the value of options will follow this one that I highlighted in yellow. Okay, so if the stock price goes up, increases in the value of call options will increase, right? Again, if the stock price goes up, increase in the value of call options will increase. Okay, if the exercise price increase, the value will decrease, and so on. Okay, you just follow the what is written in the yellow. So remember those in this slide. This is because of the next formula, which is here. So here we have something called Black-Scholes options pricing model. This is one of the approach to calculate the value of the options, okay, to calculate the price of options. Now we are done with the options that are traded in the market, in the stock exchange, sometimes is by broker, okay, depends. Now because our topic is about options, we will talk about other options in real life. We have something called options on real assets. Real options, it's options embedded in the real assets, such as options to abandon and options to expand. So what is the idea here? If you are a manager in a company, you always have the options to abandon a project, right? There is also an option to expand the project. So when you enter with the project with other company, sometimes you have the option to expand your project. Sometimes you have the option to abandon or stop the project, right? So this one was options on real assets. When you buy an investment, you can stop it, you can sell it, sometimes in the contract. Again, because we are talking about options, there is also some options in financial assets. Now there's other options in real life, such as executive stock options. Executive stock option is a long-term call options given the executives as a part of their compensations package. So when we compensate the executive, okay, like the board of directors, sometimes we give them stock options, and this will give them the right to buy the shares of the company at a good price, at a lower price. So this is part of compensations at the end of the year. Another thing called warrants, okay, this will give the right to buy shares from the company at the stipulated price before a set date. This is similar to executive stock options, but it will be given to everyone. Then we have something called convertible bonds. Convertible bond, this is the bond that the holder may exchange for a specific number of shares. So if you buy a convertible bond, this type of bond gives you the options to convert the bond into a specific number of shares. Okay, the last one called callable bond. This is the bond that may be repurchased by whom? By the issuer before the maturity at a specific call price. So when the issuer, like a company or government, with they issued a bond, sometimes the issue sold a callable bond, and this type of bond give them the option to repurchase the bond again from the visitor before the maturity date. So you have the option as a company to buy it again from the visitor before the maturity date at a specific price. So think on it as a different product that we have in the market. Okay, so that's for today, for this lecture today. Thank you so much, and if anyone have a question, they can ask me now, or you can post it in the black board, the discussion. Okay, العفو. So please don't forget the assignments. Anyone didn't do the assignment yet? Any assignment, even the first assignment, please post it. Okay, so okay, see you inshallah next week. Assalamu alaikum wa rahmatullahi wa barakatuh.